The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, if you were someone watching the soybean market on Wednesday, you probably were not a fan of how we traded. Soybeans really kind of hit the tank on the day. New contract lows, a lot of pressure in bean meal, bean oil. That weighed on corn and wheat to some degree. We were mixed in livestock. We got a Fed rate cut decision as well, and we still got fallout from all of this continuing resolution, farmer aid policy, and much more. We're going to dive in and talk about all of this. Joining us for analysis, Mike Zuzolo with Global Commodity Analytics. And Mike, we missed you last week. Welcome back to the show. Always good to chat with you, my friend. Merry Christmas.
You too, Jesse. Merry Christmas to you and all the great viewers out there on the program.
Well, a couple days ago, I was thinking we were getting a Santa Claus rally, particularly in the corn market. Well, Santa gave us some coal in our stocking here. Soybeans, just a ugly, ugly day on Wednesday. I'm just going to open this up to you and let you take it here. What exactly are we watching? What is going on in this soy complex? It's a little concerning, Mike.
It's very concerning. It's multi-layer. When you started out the program, said if you woke up Wednesday and looked at the beans, I almost said you probably thought it was Tuesday again. I mean, this has been all week, essentially. This whole week we've been eroding the price in soybeans. The origin, the source of the decline, I think, has to be put at the foot of the Brazilian real. It continues to make new record lows pretty much all week this week against the U.S. dollar. And this chart shows us the Brazilian port price at Paranagua for cash beans against the United States in red and Argentina in green. And this chart looks exactly the opposite of the corn chart for the exact same areas. The bean price has continued to erode. It's now $30+ a ton cheaper in Brazil, but it is like a magnet right now. The real being the worst currency on the planet, Jesse, down over 20% year to date, and they're really piling into the short positions, I suspect, in the funds in the soy complex as a result of this, especially. And as I said, we don't have it on this week's update, but if you look at the corn chart for these two same locations, we actually are discounted to the Paranagua price. Last I looked, it was around $20 a ton. So it's a completely different look in this market. But the policy, both in terms of China policy, U.S. policy, trade issues, I think have had to have added to the negativity and increased this selling momentum.
Well, and let's another chart here I'm going to pull up, and I'm going to throw this thought too. We had the NOPA crush numbers out Monday that for November was still a record, but it was much lower than trade expectations. So I think some disappointment there to start the week. And then to your point, looking at exports, whether we're talking beans, bean meal, beet oil, just across the board, this whole soy complex is just, it seems like it's falling apart, Mike.
Well, and it's one thing after another. Late on Tuesday, I believe it was, Bloomberg broke a story that said that China was going ahead and backing up imported soybeans at their ports and essentially starving the interior markets to drive domestic prices higher for their farmers to get a better price. And so these things are just kind of piling on at this point. But you bring up a big point, because the product markets are just as bad as the soybean complex when it comes to the news. And this chart technical here, the annual soy meal price that we're looking at right now, we continue to see China's meal prices suffer, and we just keep falling with them. We've actually now taken out the 2020 lows. We are actually now down at the lowest prices since about 2016 in the meal market. And I think this goes back to what we've talked about at least maybe 2 weeks prior to last week when we didn't talk. Was the idea that I think this meal market is the key to turning everything around as far as the soybeans and the confidence coming back in terms of the soy complex with China.
Well, another chart. We'll keep looking at these. Here's the annual soybean continuation chart. Walk us through what you're seeing here, Mike.
Yeah, and this is going to be a little bit more difficult to digest to the viewer, and that's where pick up a subscription or give me a call after this program after the market closes. But what I see in this market with meal and also the policy fears now coming into the soybean oil longs and the sustainable aviation fuel question by the longs, and that causing liquidation by longs, in my opinion, we have pretty much all 8 cylinders running to the downside right now. We really can't throw too much on top, more on top of this market, unless China physically comes out and cancels soybeans in the next several days before the holiday. And what I'm driving at here, Jesse, is we're up against a pretty crucial support level again on this annual soybean chart around the 940 area, 935 areas where we got down to earlier this year, while the meal has taken out its August lows and, as I said, made new 6+ year lows at this point. We have not taken out the annual low yet in the soybeans. That 940 level on a monthly close is exceptionally important, and then right below that is an uptrending support line in blue, and then the next big long-term support line of 840. And so when I look at this chart and I talk about what I'm talking about with you today, I can say with some validity that the market has taken most, if not all, the weather premium out of the South American crop. I don't think they've even thought about the January crop for USDA's report and the WASDE numbers being potentially bullish for beans and another potential yield decline. And I think when everything's all said and done, the weaker the currency goes, and this comes straight from my South American colleague that I work with, the lower the Brazilian currency goes, because their beans are priced in dollars, they won't sell, in his opinion. The farmer selling will dry up and they'll hold beans in Brazil. So I'm getting more of the mindset that unless something new comes around, like a Chinese cancellation, I think we're setting up a major low in the soybeans, or at least a sideways consolidation phase going into the January 12th report, and maybe have a low right after that report comes out.
Well, and to that point, I'm going to throw this out here as we take a look at another chart. We're looking at that bean corn ratio for 25. You think about what this acre mix could look like. I take a look at just the cash bids right now for soybeans, and a lot of mid to upper 8s across the board. Still plenty of 9s in the eastern belt, but you look at that, you look at this board price falling apart here a bit, and I hate to say this, Mike, but I have to wonder. I mean, are sub $9 beans in the cards here if we have them, if we break some these trend line supports that you're talking about?
Yeah, I think they are for a time. I think that's the question mark, but I think that then runs you into, and this is why I think the corn market, this chart helps explain why the corn market finally threw in the towel on Wednesdays, because this spread's just too stretched. I mean, we're down at the contract lows and went through the contract lows from 2022 in new crop bean corn ratio. We're down to 22 levels as well in the lead month futures, Jesse. And so the corn can only hold up so well up against this kind of a pile-on to the downside in the beans. And this is why we took out some short-term moving averages in corn that I didn't want to see taken out since the December futures went off the board last week. It kind of opens us up to the downside, technically speaking. And this, we know how momentum is. We know how the charts mean a lot when this kind of stuff starts to roll and it takes on its own life. So I think, hedging corn is something to really look at here, given the fact that these beans have done what they've done. And most important, the wheat has not come around and turned this market higher like I've wanted it to, and like it should be doing, given the positive fundamentals coming out of the Black Sea, given this massive purchase by Saudi Arabia that we're hearing about, given fresh tenders of South Korea and fresh tenders in Tunisia.
And that's a great point. I've noticed the last several days that corn and wheat have kind of traded in sympathy with each other, whether it's higher, whether it's lower, but they've kind of clung together. But to your point, this is something you and I talk about all the time, wheat being the leader in these markets, and that's really not happening right now.
No, and wheat and copper still have about a 90% positive relationship with one another on an 8-week basis. And there again, it goes back to China. And what I'm really driving towards when it comes to your earlier point about the sub $9 beans is we're getting to a point now, we're mid-December, where U.S. farmers are going to need some cash flow pretty soon. And I could see them selling corn out of the bin because it's a better price. I talked to a Nebraska client near an ethanol plant just today, still running around $4.50 for spot corn right now. and that's a lot better looking price than 8.75, 8.90 a bushel. So I think we need to really get ahead if we can of this market. As far as if we got some spot sales we need to make, we might be wanting to do it before the Christmas holiday, especially given what we heard from the Federal Reserve today.
Mike Zuzolo, Global Commodity Analytics, is our guest analyst here today on Market Talk. Let's talk about that Fed decision, and we can weave in the dollar discussion here and much more. The Federal Reserve cut interest rates 25 basis points as expected for December. Looked like I saw some indication they expect to cut rates twice next year at least. What's your thoughts on the Fed news? What are we seeing with the U.S. dollar here as of late, et cetera, Mike?
Yeah, that's my understanding as well. And that's kind of a disappointment to the doves out there, the people that thought that the traders and the bond pits and the currency pits that thought the U.S. would be on this rate cutting binge and really keep the commodities afloat and keep the bond yields down. And I think this is where the trade policy issues come into play here, Jesse. We really need a couple headwinds for the dollar, not all tailwinds. And today's Federal Reserve update, from what I've read so far, and the reaction by the dollar, if you look at this spot dollar weekly contract, you see that we're on a wedge pennant formation and we're breaking higher. That 107.32.50 level has already been taken out since I created this chart. We are making new weekly highs and almost new monthly highs now in the dollar as an initial reaction to the Federal Reserve. And that suggests to me that we're going to see bond yields go back up, and bond yields feed a strong dollar. And that's exactly the opposite of what we want right now, especially with the issue with the trade issues, because we're already fighting the weaker Brazilian currency. We're already worried about a weakening Chinese currency because China wants it, because they want to export their way out of their problems instead of kickstarting their domestic consumption. We need a weaker dollar at this point, especially given that we're in that 107 level once again. So not a good midweek discussion here on the market talk. I admit it, but this is the reality we're in right now before the holiday.
Well, and I hate to be a Grinch too, but I think coupled with this, and I know you and I, both of us, do not like to get political in any way, and I'm trying to avoid that here, Mike. But I'd be remiss if I didn't at least bring up this whole economic aid package. What potential impact could this have on the markets, positive or negative? I'm seeing a lot of folks, a lot of your average small farmers saying they don't want the handout. I think it personally might be a Band-Aid on an issue, but with trade concerns ahead and more, there's so much to unpack here. So I'll step back and take my opinion out of this here and just ask you, what do you feel like this whole package could mean for the markets, at least, Mike?
Well, it's just one big piece of the overarching issue for the trade that you're going to put the commodities and the ag commodities on the sell side of the spreads. And I just saw before we went on air and before the market closed on Wednesday that the Congress is looking at fresh sanctions on China. Every time we slap more sanctions on Russia, the Russian ruble goes down. Every time we slap more sanctions on China, the Chinese yuan goes down. Then the dollar rallies and the grains become the short side of the spread, especially given us talking about not just China, but also Mexico and also with Canada. And you notice in the livestock market, the trade's trying to parse a little bit about what would happen if we went into a trade mix-up with Canada and Mexico. And they're giving the cattle a little bit more free space to hold their gains, because net, Mexico is our number one buyer of pork, but net, if we had trade disruptions with Canada and Mexico, we'd have less beef here, less live cattle here in the United States, if you look at the figures at this point. But I think to your point, Jesse, is that the producers I work with and the producers you talk to, we want free and fair trade. The new president wants that, but unwinding this ball of yarn we knew was going to be tough. And I'm not throwing in the towel yet. I will restate what we talked about not too long ago. I think President Trump, based upon my research, wants to use the tariff scare and threat as a negotiating tool. He's willing to use it if the negotiations don't go well, but I'm not so sure the negotiations can't go well at this point. And I say that especially with China, because their economy is worsening. A brand new study just came out about what would happen if the full 60% tariffs went on China. They'd go down to a 2% GDP. That would be an unemployment rate China just could not stand, especially given already seeing some of their domestic issues, like people driving into crowds, more attacks. The social unrest is starting to be reported in China. So I'm not pessimistic about the final deal. It's what we have to work through in between.
I appreciate your thoughts and your candor on that. I do want to talk livestock trade with you here as well. A little bit of pressure in cattle has started to kind of develop here. Cattle on feed reports coming up here. Let's talk in that cattle trade. First, let's look at cash cattle futures. This chart here, futures and cash. What are you watching in the cattle trade here ahead of the end of the week?
I think this chart shows us pretty clearly that the negotiated cash price is really the best thing going for the cattle market right now. We've got a wobbling hog market. We've got a wobbling stock market. And in fact, some of the monthly charts I looked at before coming on air here today on Wednesday afternoon suggested that we might be in a sell signal territory for the S&P 500 futures. And we'll get to that in a minute. But I think this chart really shows us where the cattle market is and how important this cash market and this cash trade is. The good side of the equation for the beef and the cattle market is the most recent USDA update last week on the retail side on major featuring by major grocery stores and outlets said featuring jumped 16%, and the activity, the sales pitches, the ads for beef in particular at more than one store was up almost 24%. So beef's really having a great holiday season right now, and it kind of surprises me. So those ultra high cash prices that we have in both feeders and fats, they are going to, I think, continue to support this market. But if the fat cattle start to give way, I don't see why the futures market wouldn't have a correction as well. And I hate to oversimplify it that much, but this chart kind of speaks that language at this point.
Well, you mentioned too some of the stock market correlations. Let's talk S&P 500 with live cattle, and this is looking at an 8-week correlation here with lead month futures. So, what's some of the latest you're seeing on this chart?
Yeah, this will be an important chart to watch in the next week or two because we've essentially swung about 80 points from a negative, roughly 40% relationship between those two markets to now a positive 40% relationship. And we get up into the 90s like we have earlier this year. That's where if Wall Street breaks, I think the funds who are so net long right now in feeders and fats both, and hogs to a lesser degree, could really have a reason to go ahead and liquidate some of their longs at this point, regardless or notwithstanding the cash market prices. And so I think my cycle work would suggest that the highs should be in or could be in, maybe in before the April fat cattle go off the board or the May feeders come on, go off the board, I should say. But those cycles are very temperamental, especially given what we're dealing with in the political side of the equation. But this chart we've been looking at for months, and it's still a very important relationship because there's a pretty tight relationship between the funds buying more when Wall Street makes new record highs.
Good stuff as always, Mike. I should ask you in the hog trade as well, real quick. We started to slip back a little bit and kind of range bound on Wednesday. I'm just wondering, is the run in hogs over? Are we going to trade sideways for a while? What are the charts telling you there, Mike?
I could see the hogs fundamentally and technically both being very violent this year, Jesse. $100 in the lead month futures, probably, I would guess, the top end, 100, 105, probably the top end at any given time. There's PRRS in some farms out east. I'm watching that. But unless we have a big disease pressure hit to this market on the supply side, I think the hogs are going to be probably top heavy at 100 plus and then have a very wide range this year in 2025 because we just can't get a bead on what China is going to do with their hog herd and whether they're going to have to liquidate again because their domestic consumption is just not there.
Good stuff. Final thoughts? Anything you'd mention or reiterate to folks today, Mike?
Just one day in the trade, and we have to be optimistic if we're in agriculture and it's the holidays, and let's focus on family and faith and leave it there.
I like that. If folks want to reach out to you too for a conversation, take a look at your analysis, get a free trial and more, I know they can do it very easily online. How can they reach you, Mike?
Yeah, globalcomresearch.com is the best place to go, and I'd be happy to talk to anybody free of charge. If they have a specific question, just sign up for a 2-week free trial there on the website.
Globalcom with 2Ms, research.com for more. With that, Mike Zuzolo, Global Commodity Analytics, I will wish you a Merry Christmas and a Happy New Year, sir. Thanks as always for joining us and the great stuff you provide us here on Market Talk. Thanks a lot.
You're a great host. You're a great man in agriculture, and you're a great friend, Jesse. Thank you.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.